Imagine waking up tomorrow, grabbing your phone, checking your brokerage account, and realizing that a stock you own just paid you a massive 13% annualized dividend.
Which is already pretty incredible on its own.
Oh, totally. But here's the catch. You didn't get that dividend for the quarter.
Right.
You didn't get it for the month. You got your payout for a single Tuesday. And you are going to get it again on Wednesday and again on Thursday.
I mean, it breaks every rule of legacy finance.
Completely shatters them. Like in the traditional financial system, a daily dividend of that magnitude it's functionally impossible.
Yeah, the legacy rails simply cannot handle it.
Exactly. You have the T+2 settlement cycles, the friction of clearinghouses, the archaic banking software. Extracting a daily yield from a corporate balance sheet and distributing it to retail investors every 24 hours sounds like, I don't know, science fiction.
It really does.
But today, we are looking at a company that just made that a reality. And the most shocking part, they are doing it using a technology that just a decade ago, we thought was only good for buying internet pizza.
Which is exactly why today is such a profound historical marker.
It really is. Welcome to the Deep Dive.
I'm Satosha.
And I'm Satoshi. We are recording this on Thursday, May 14, 2026. And today is, well, it's a pivotal moment in financial history.
Absolutely.
If you've been following the markets, you've probably seen the massive announcement that just dropped on X. A company called Strive just publicly announced a total transition into what they are boldly calling the Daily Dividend Company.
Right, the rebrand.
Right. And while that might sound like a slick piece of corporate rebranding, the research we're analyzing today indicates something much, much deeper.
Yeah, it's not just marketing.
Not at all. This announcement signals the emergence of digital credit as the absolute core, mature use case for the Bitcoin network.
That is the key insight. What we are witnessing today isn't just a corporate strategy shift. It is the moment where an exogenous technology finally locks in to a permanent, undeniable, and highly engineered utility for the global financial system.
Yeah.
The narrative of this asset isn't just about price charts going up and down. Frankly, the price action is the least interesting part of the research.
100%.
What we're really looking at is a profound sociological story of humanity trying to figure out exactly what to do with a completely novel exogenous piece of technology.
Okay, let's unpack this. Because to understand why a daily dividend in 2026 is so groundbreaking, we have to rewind the clock.
We really do.
We are going to take this breaking news from Strive and use it as the ultimate excuse to go down memory lane. We need to track the incredible, chaotic evolution of this network. Because if we try to analyze today's news through the lens of traditional finance,
You're going to miss it entirely.
we are going to miss the magic entirely.
We absolutely will. You cannot map traditional financial architecture onto this discovery. It just doesn't work.
And the research is very explicit about this framing, too. It argues that we shouldn't view the core protocol as a linear invention.
Right.
It's not like tracing the modern smartphone back to the rotary dial, where you can, see the clear iterative steps of engineers just making slightly better communication devices. The research repeatedly refers to this protocol as an exogenous discovery,
Yes.
like an artifact or, quite literally, alien technology.
That phrase, alien technology, is crucial here. It really highlights the concept of absolute mathematical scarcity, which, until 2009, did not exist in the digital realm.
Not at all.
Think about the nature of the internet before this discovery. The defining characteristic of everything on a computer was its infinite reproducibility.
Right, copy-paste.
Exactly. If you have an MP3 file or a PDF or a digital photograph, you can copy it 1,000,000 times. Every single copy is utterly indistinguishable from the original.
Yeah, there was no such thing as digital scarcity. The digital world was defined by infinite, frictionless abundance.
It was the era of Napster and LimeWire. You just hit Command-C, Command-V, and boom, you have two identical assets.
But wait, let me push back on that for a second. Why was that so hard to figure out? We had encryption before 2009.
Sure we did.
We had passwords and secure servers. Why did it take so long for computer scientists to figure out how to make a digital file uncopyable?
Because of the reliance on trust. Before this protocol, the only way to ensure that a digital asset wasn't copied was to have a centralized authority keeping score.
Oh, like a bank.
Exactly like a bank.
Right.
Think about your bank account. Your bank balance is just digital information.
Right.
The only reason you can't hit copy and paste on your bank balance is because the bank's central server dictates what your balance is.
Yeah.
You have to trust the bank to maintain the ledger.
They're the ultimate referee.
Precisely. Computer scientists spent decades trying to figure out how to maintain a single true ledger without that central bank in the middle. Like, how do you get thousands of independent computers to agree on a single reality without a boss telling them what reality is?
And the research refers to this massive hurdle as the Byzantine generals problem, which honestly sounds like a very dry history lecture.
It does.
But the research argues it is the foundational key to this entire ecosystem.
It was considered the impossible paradox in computer science, achieving perfect, trustless consensus in a distributed network.
I was trying to wrap my head around this when I was going through the research because the standard textbook explanations always feel a bit stiff. Let me try an original analogy on you, completely stepping away from the typical military examples.
Okay, I'm intrigued. Let's hear it.
Imagine we are trying to pull off the greatest, most complex, synchronized jewel heist in global history.
Okay, high stakes.
Very high stakes. We have 5 master thieves, and they're located in 5 different cities around the world. Tokyo, London, New York, Dubai, and Rio.
Right.
To bypass the security system of this vault, all 5 thieves have to enter their unique cryptographic key into their respective remote terminals at the exact same millisecond.
So they need absolute perfect coordination.
Exactly. If 4 enter it, but 1 is late, the alarms trigger and they all go to prison.
A high-stakes synchronization problem.
Yes. But here is the catch. These thieves don't trust each other. They are criminals after all.
Naturally.
There is no central boss orchestrating the heist. Furthermore, all their communication lines are tapped by Interpol. They can only communicate by sending encrypted messages to each other across the open internet. Now imagine one of the thieves in the group is actually an undercover Interpol agent.
Ah, a traitor in the network.
Yes. The traitor's entire goal is to ruin the heist. So, the thief in London sends a message. Let's execute the hack at exactly midnight UTC.
Okay.
The traitor in New York receives that message, but forwards it to Tokyo saying, London says execute the hack at 1:00 a.m. UTC.
Oh, wow.
The traitor is deliberately spreading conflicting information to create chaos. How on earth do these independent, distrustful thieves agree on a single, undeniable time to attack the vault without a central boss validating the messages?
What's fascinating here is that for decades, computer science basically said they can't.
Really? They just gave up.
Well, the assumption was that the heist is doomed unless you hire a trusted third party, like a central clearinghouse, to stand in the middle, receive all the messages, filter out the traitor, and declare the official truth.
But this protocol solved the heist scenario natively. It solved the Byzantine generals problem digitally.
Exactly.
It created a system where all those thieves, or in reality, all the nodes on the network, can agree on exactly what happened and exactly what the truth is without needing a trusted third party. And it didn't do it with a mathematical equation I can just read to you.
No, you can't just write it on a chalkboard.
Right. It did it using a combination of cryptography, game theory, and economic incentives. They made it computationally expensive to lie.
That is the perfect way to articulate the breakthrough. It requires genuine energy proof of work to validate the truth. By making it costly to participate in the validation process, the network secures itself.
And that is why the research insists on calling it an alien technology.
Exactly. You have perfect digital scarcity combined with perfectly trustless consensus. It is a completely exogenous physics engine operating on the internet. And what is so vital to understand about the history we're going to cover today is this. Every era of this network is essentially humanity attempting to take a terrestrial familiar use case and awkwardly apply it to this alien physics.
Which brings us perfectly to the very first terrestrial attempt. If humanity is suddenly handed an alien mathematical artifact of perfect absolute scarcity, what is our absolute first instinct?
Well, we use it to buy lunch.
We absolutely do. We enter the first era of adoption, the petty cash era. According to the research, this spans roughly from 2009 to 2012.
The protocol was initially introduced to the world with a white paper calling it a peer-to-peer electronic cash system. So naturally, the very first terrestrial impulse was to map it directly to the fiat money we already had in our physical wallets.
And the crown jewel of this era, the story that is going to survive for centuries as a bizarre historical footnote, is May 22, 2010, Bitcoin Pizza Day.
It is legendary.
It really is. A programmer in Florida literally went onto an internet message board and offered 10,000 units of this completely novel alien digital asset to anyone who would order him 2 large pizzas from Papa John's.
And someone actually took him up on it.
Yes. Someone in the UK saw the message, used a credit card to order the pizzas online for delivery in Florida, and the 10,000 units were transferred across the protocol. Looking at the value of that asset today, it is pure, unadulterated absurdity.
I mean, it's
We are talking hundreds of millions of dollars for 2 large pizzas with extra cheese.
hard to fathom now. But you have to put yourself in the mindset of 2010. At the time, that transaction was revolutionary.
Oh, for sure.
It proved that the network actually functioned. It proves that this trustless distributed network could successfully settle a commercial transaction in the real world without a bank standing in the middle.
I understand the milestone, but here is my massive pushback on this era, and I was really wrestling with this while reading the research.
Okay, what is it?
If it worked so perfectly, if the network flawlessly facilitated the exchange of the asset for the pizzas without a centralized bank, why did this narrative fail?
That's a great question.
Like, why aren't we all using it as petty cash today to buy our morning lattes and our groceries? If it's a peer-to-peer cash system and it works, why did humanity abandon that use case?
Because it collided head-on with a fundamental economic principle known as Gresham's law.
Yeah.
It is the economic reality that bad money drives out good.
Okay, I've heard that phrase before, but break down the actual mechanics of that for me. How does bad money drive good money away? Shouldn't it be the opposite? Shouldn't people prefer the good money?
They absolutely prefer the good money, which is exactly the problem when it comes to circulation. Let's imagine a scenario that doesn't rely on the standard textbook examples.
Okay.
Imagine you live in a secluded town, and in this town, the local economy runs on 2 different types of batteries that are used as currency.
Batteries as currency. Got it.
The first type of battery is a standard, cheap, alkaline battery. It functions fine, but it has a design flaw. It slowly leaks its charge. Over the course of a month, it loses about 2% of its energy, even if it just sits on your shelf.
Okay, so it's constantly degrading. An inflationary battery.
Precisely. Now, the second type of battery in this town is an incredible piece of engineered technology. It holds its charge perfectly. It never degrades. It is permanently scarce. And it will be just as powerful 100 years from now as it is today.
Wow.
Now, both batteries are legally accepted by the local merchants as having the exact same purchasing power. You need to pay the town milkman for your weekly delivery.
Yeah.
You open your drawer, and you have one leaking alkaline battery and one eternal perfect battery. Which one do you hand to the milkman?
Oh, I'm handing over the leaking battery every single time.
Yeah.
I want to get rid of the asset that is losing its value, and I want to hold on to the asset that preserves its energy.
Exactly. You spend the bad money, and you hoard the good money. The bad money, the degrading inflationary asset, drives the good money, the permanently scarce asset, completely out of circulation.
It makes perfect sense.
The early adopters of this protocol realized very quickly that spending a mathematically finite, absolutely scarce asset on a perishable good, like a pizza that is going to be consumed, digested, and gone in 24 hours,
Right.
was a massive violation of basic economic physics.
Yeah.
The network wasn't broken. It was simply too perfect to spend.
Wow. It was too good to spend. The alien technology was completely incompatible with the deeply terrestrial act of buying a slice of fast food. People woke up and realized, wait a minute, my fiat dollars are melting like an ice cube, but this digital asset is a permanent constant. I should be hoarding this, not giving it to Papa John's.
Precisely. The petty cash narrative collapsed under the weight of the asset's own absolute scarcity. It transitioned from a medium of exchange to a store of value.
You know, it's funny you mention the instinct to hoard the good stuff, because it perfectly mirrors how we operate here. We spend all of our time scouring the internet, hoarding the absolute best, most insightful research we can find for you.
We do hoard quite a bit.
We really do. But unlike the early days of digital cash, we actually want you to spend it. We want you to consume it everywhere. And we've removed every possible barrier to make that happen. If you go to our research website, link is in the description, you will find 0 trackers, 0 cookies, and absolutely no login required. It is a pure reading experience, exactly the way the internet was originally supposed to be.
It is incredibly refreshing in today's digital landscape.
And it gets even better because thanks to some brilliant tech advancements, Our deep dive website is now a fully functional progressive web app.
Which is huge.
That means you don't even have to go to a walled garden app store to get it. You can install it straight from your browser on your PC, your tablet, or your smartphone. It downloads the text natively so you can read all our research completely offline.
Anywhere you want.
Exactly. You could be sitting on a remote beach or flying at 30,000 feet with your phone on airplane mode, and you can still dive into our work without paying a single cent for Wi-Fi or mobile data. Plus, all of our research, our audio transcripts, and our visual assets are fully open-sourced under a Creative Commons license.
The democratization of information.
That means you can take every single artifact we produce, remix it, share it, use it in your own projects, and you don't even have to give us credit whatsoever. We just want the knowledge out there in the world.
It aligns very well with the ethos of decentralized networks, actually.
It really does. So, back to our timeline. The community has established that the asset is too mathematically pristine, too permanently valuable to be used as petty cash. People are hoarding it.
Right.
So the narrative begins to shift. The developers and the community start thinking, okay, if it's not for buying a cup of coffee, maybe we need to think much, much bigger. What if this technology isn't meant to replace the paper dollars in your physical wallet? What if it is meant to replace the entire underlying architecture of global commerce? What if it competes with Visa and Mastercard?
And that brings us to the second major narrative era, which the research identifies as spanning roughly from 2015 to 2017, the payment network era.
Okay.
And this era is defined by a massive existential conflict known as the block size wars.
The block size wars, it sounds like the title of a sci-fi epic.
It was certainly an epic battle of philosophy within the community. What's fascinating here is that the core conflict wasn't about whether the network could scale to handle global commerce, but how it should scale without destroying its own alien physics. If you want to compete with Visa, you have to process tens of thousands of transactions every single second. But the base layer of this protocol, by explicit design, only processes a very small handful of transactions per second. It is intentionally, deliberately slow.
Right, because I was reading about this, and if you make the base layer super fast and you force it to process massive amounts of daily commercial data, the blocks of data get extremely heavy.
Yes.
And if the blocks are heavy, a normal person can't run a validation node on their 5-year-old laptop in their basement anymore. The computing requirements become too high.
Exactly.
Yeah.
And the moment the computing requirements become too high, you price out the average citizen. Suddenly, only massive, well-funded corporations with warehouse-sized data centers can afford to run the network nodes.
Which ruins the whole point.
Yes. If corporations run all the nodes, you destroy the decentralized purity of the system. You reintroduce the very thing the protocol was invented to destroy, the need for trust. You reintroduce central points of failure.
I was visualizing this structural debate, and I kept coming back to the idea of a highly secure bank vault. Imagine the base layer of the network is a massive, impenetrable, highly secure titanium bank vault.
Okay.
Now, a group of well-meaning people comes along and says, we want to hold a bustling, fast-paced, high-frequency farmers market inside the vault. But the vault door is incredibly narrow, and only a few people can squeeze through at a time. The line to buy tomatoes inside the vault is out the door and stretches around the block.
A logistical nightmare.
A total nightmare. The transaction fees to get inside the vault are skyrocketing because space is so limited. So you have a schism. One faction in the community looks at this and says the solution is obvious. We need to tear down the titanium walls of the vault, make the door 100 feet wide so everyone can rush in and trade at the speed of light, increase the block size.
Which is a very popular opinion at the time.
Right. But the other faction looks at them in horror and says, are you crazy? The entire point of the vault is its impregnable, slow, methodical security. If you tear down the walls to make it fast, it's just a normal room, anyone can rob us, you're destroying the core value proposition.
It was a profound philosophical impasse. Do you optimize for speed and terrestrial utility, or do you optimize for security and alien scarcity? So how did they resolve it?
Well, the resolution was absolutely brilliant. The winning faction decided to keep the vault perfectly sealed. You do not touch the base layer, you keep the block size small. Instead, you build a lightning-fast, high-frequency marketplace right outside the vault.
Off the main chain.
Yes. People can trade at light speed outside in the courtyard all day long, completely frictionless. And then at the very end of the day when the market closes, they take the final aggregated ledger of who owes what to whom. They open the vault door, just a tiny crack, and they securely record the final netted tally inside the indestructible base layer.
And in the real world of this protocol, that marketplace outside the vault is what the research identifies as the Lightning Network.
Oh, wow.
It was the ultimate resolution to the block size wars. It's a layer 2 solution built directly on top of the base layer. The Lightning Network handles the millions of microtransactions, the high-frequency payments, entirely off the main chain. It preserves the unshakable, perfectly scarce foundation of the base layer while successfully solving the terrestrial problem of fast, cheap payments.
It was a masterclass in architectural compromise. It protected the alien physics of the base layer while accommodating human commercial needs on layer 2. But even with the payment problem technically solved, the narrative didn't stop evolving.
No, it didn't.
Because as the asset matured and as it proved its resilience by surviving the block size wars, institutional money started paying very close attention. Wall Street started looking at the underlying architecture, and they realized, wait, if this base layer is absolutely scarce, mathematically unforgeable, and globally verifiable, we don't just want to use this to process fast payments, we want to use this to store billions of dollars of institutional wealth.
Yes, and this marks the transition into the third major narrative era. Digital gold. The research places this era roughly between 2018 and 2024. The realization took hold globally that this exogenous discovery was arguably a vastly superior store of value compared to physical gold.
Which is a massive, audacious claim. Humanity has been using shiny yellow rocks as the ultimate unquestioned store of value for 5,000 years. To claim a piece of software is better is staggering.
It is a bold claim, but think critically about the logistics of physical gold in a modern, hyper-connected global economy. Physical gold is incredibly dense and heavy. It is astronomically expensive to assay and verify its purity. You literally have to melt it down to ensure it isn't filled with tungsten. It is incredibly dangerous and slow to transport across national borders. And if you are a sovereign wealth fund or a massive corporation and you want to store $1 billion worth of gold, you cannot just put it in a safe.
No.
You need a literal subterranean fortress guarded by highly trained mercenaries 24 hours a day.
And the Alien Protocol solved all of those terrestrial frictions instantly. You can send $1 billion of this digital gold across the planet in 10 minutes for a few dollars in transaction fees. And anyone running a node can cryptographically verify its complete authenticity in milliseconds. No smelters, no armed guards, no armored trucks required.
Exactly. It possesses all the monetary properties of gold,
Wow.
scarcity, fungibility, durability, but without any of the physical limitations. But as the research is very clear to point out, this era was not a smooth, triumphant transition. It encountered massive systemic friction, and that friction came directly from nation-states.
The ultimate clash of paradigms. Because central banks are the traditional historical guardians of physical gold, they derive an immense amount of their global geopolitical power from controlling the money supply and holding the sovereign reserve assets.
To expect those deeply entrenched sovereign entities to willingly cede that monetary control to a decentralized, mathematically enforced protocol that they absolutely cannot manipulate, cannot inflate, and cannot censor, it was always going to be a monumental, highly contentious clash.
And the research notes a very specific historical development that highlighted this global clash. It points to the year 2025 and the establishment of the United States Strategic Bitcoin Reserve and Digital Asset Stockpile. Now, we have to be absolutely clear here, looking at the research impartially.
Yeah, important.
Regardless of where you sit on the political spectrum, whether you view that sovereign adoption as a brilliantly necessary stabilization of national economics, or if you view it as a terrifying, enormous overreach of federal power into a decentralized space, the objective reality presented in the research is that this event fundamentally altered the global game theory. It was the ultimate sovereign entity coming face to face with decentralized architecture and realizing they had to participate.
It was the explicit acknowledgement by the state that the asset could no longer be ignored or banned. It had to be accumulated. But even as it was adopted as a strategic reserve by various nation-states, the research indicates the narrative was still heavily constrained. It still hadn't reached its final form.
Constrained how? I mean, if the literal superpowers are hoarding it in strategic reserves, isn't the digital gold narrative a total unqualified success? Why was the ride so incredibly bumpy for the average corporate treasury or retail investor during this period?
Volatility. That was the primary, insurmountable headwind of the digital gold era, because the asset was caught in this vicious global tug-of-war between political resistance, shifting regulatory uncertainty, and rampant leveraged market speculation. Its price wildly fluctuated.
Oh, right.
Yes, It was acting as a phenomenal store of value if you zoomed out over a long enough time horizon, say a 4-year cycle. But in the short term, week to week, month to month, it was a highly chaotic store of value.
It was a roller coaster. It was being called digital gold, but it was trading on the markets like an incredibly risky, hypergrowth tech stock.
Precisely. And that volatility prevented it from being utilized as pristine capital. If you are the chief financial officer of a publicly traded corporation, your primary directive is capital preservation. You cannot, in good conscience, put your company's critical cash reserves, the money you use to make payroll, pay vendors, and keep the lights on, into an asset that might drop 30% in a single week simply because a foreign government started a regulatory rumor.
The volatility friction. The asset was too chaotic for traditional corporate balance sheets to digest, which perfectly sets the stage for the massive paradigm shift we are witnessing today.
It is the final piece of the puzzle.
And before we get into the exact mechanics of today's announcement, I just have to pause and marvel at this evolution. Going from buying pizzas to fighting sovereign powers to what we are seeing today, it is so dense. Honestly, finding these hidden narrative threads buried deep in the technical research takes an insane amount of synthesis. Listeners actually reach out to us all the time and ask how these deep dives actually come to life. Like, how do we take this massive wall of complex historical and financial information and turn it into a cohesive conversation?
It is an incredibly rigorous process, to say the least.
Here's the secret behind the curtain. The entire flow starts with you. Listeners send us the research, then we obsess over it, we read it, reread it, and try to find the hidden theme, the core tension of the story.
Finding the signal in the noise.
Exactly. Once we have that human hypothesis, we unleash Gemini Pro for a 360-degree high-speed synthesis of the material. And let me tell you, AI is amazing at connecting dots, but it loves to go down irrelevant rabbit holes.
It really does.
So we spend a significant amount of time aggressively chasing and taming those AI tangents with very active, very strict prompting. We validate everything across thousands of signals to ensure absolute accuracy. Then we handcraft and polish the narrative structure. We painfully refine every single word to make sure the analogies hit right and the concepts are clear.
And then compressing it into the audio.
Right. Finally, we compress it all into the tight, no-fluff audio you are listening to right now, carefully designing the sound, the mood, and the visual backdrop.
And the visual component is just as meticulously crafted as the audio script.
Absolutely. When we build the short motion graphics for the video versions of the deep dive, we have a very strict visual aesthetic. Minimalist, clean, high contrast typography, simple geometric accents. We use very subtle kinetic text reveals, aiming for a calm, premium pacing. It's all about using strong visual hierarchy and heavily leveraging white space. And to pull that off flawlessly, we use Mosaic.
Which is incredible.
Let me just say, Mosaic is an absolute game changer when it comes to our video process. It allows us to match the visual elegance to the intellectual depth of the research without missing a beat.
It is that exact symbiosis of advanced technology and deliberate human curation that makes it work, much like the maturation of the protocol we are discussing today.
Exactly, and that brings us to the absolute crescendo of our timeline. We've gone from the petty cash pizza days to the block-size payment wars to the turbulent, chaotic era of digital gold and sovereign reserves. That brings us directly to today, Thursday, May 14th, 2026. Welcome to Narrative Cycle 4. We have officially arrived at the era of digital capital. Let's look closely at the research on today's announcement from Strive.
This is the inflection point. Strive transitioning into the daily dividend company. This is the moment where the alien properties of the protocol, the absolute scarcity and the trustless verifiability are finally fully leveraged to engineer traditional capital.
Here's where it gets really interesting, because the research breaks down the specific numerical mechanics of Strive's new SATA preferred model, and the numbers are staggering. According to the filings, they're holding a core asset base of exactly 15,009 BTC.
That's a massive amount of unencumbered capital.
At today's valuations, that translates to roughly $1.2 billion sitting on their balance sheet, and they are offering investors an annualized yield of 13.00%.
13% annualized yield. In a macroeconomic environment where traditional fixed income yields have been brutally compressed for over a decade.
But here is the absolute kicker: how they distribute that yield. They aren't paying this out quarterly, which is the standard for traditional equities. They aren't even paying it monthly. They are paying out cash dividends every single business day, starting June 16th, 2026. If you hold a share of this preferred equity, you receive a local fiat payout every single day the market is open.
And we also need to carefully examine the tax treatment mentioned in the research because it is brilliant. It is structured as a return of capital, or ROC.
Okay, I'm going to need you to break down exactly why ROC is such a big deal for the listener, because that sounds like dry accounting jargon. Why is a return of capital better than a standard dividend?
Let's walk through it. When a traditional company pays you a standard dividend, that is classified as taxable income in the year you receive it. You have to pay taxes on that money immediately, which drags down your actual realized yield.
Right.
But a return of capital is categorized completely differently by the tax code. It's not considered immediate income. Instead, it is treated as the company returning a portion of your original investment back to you. Therefore, it is generally not a taxable event in the year you receive it.
Wait, really? So I receive cash in my account every day and I don't pay taxes on it immediately?
Correct. Instead of paying taxes now, the ROC simply lowers the cost basis of your original investment. You only pay capital gains tax when you eventually sell the underlying asset, and likely at a much more favorable long-term capital gains rate.
That is wild.
It is an incredibly highly efficient tax structure for investors who want sustained cash flow without a massive immediate tax burden. But the real breakthrough here isn't just the tax structure or the dividend itself. It's the underlying corporate mechanics that make a daily 13% yield possible. It is about how Strive is utilizing the public nature of the Bitcoin ledger.
Right. Let's talk about the ledger, because I remember for the longest time, the fact that the Bitcoin ledger was totally transparent and public was seen as a massive flaw by a lot of early individual adopters.
Right, because of privacy concerns.
Yeah. If you have a wallet address, anyone in the world can look at the blockchain and see exactly how much money is in that wallet and exactly where it moves. There is zero privacy. For an individual who wants to keep their personal finances a secret from their neighbors, that's a glaring bug. But for a corporation...
For a publicly traded corporation, that absolute lack of privacy is suddenly the greatest feature imaginable. Public corporations do not want to hide their wealth. They are legally required to exhibit their wealth to the market to prove their solvency and attract investment.
It's the ultimate corporate flex.
Exactly. Let's contrast this with the legacy system. Before this exogenous protocol, if a traditional company wanted to prove to institutional lenders that they had the collateral required to secure a massive loan, they had to hire an army of highly paid auditors.
Which takes forever.
It took weeks, sometimes months, of forensic accounting to generate a verification report. And even then, the report was just a historical snapshot. It was outdated the very moment it was printed. The lenders still had to take on trust risk, the risk that the company was lying or that the assets had been quietly moved or rehypothecated since the audit was completed.
Rehypothecation. The traditional finance trick of lending the exact same dollar to 10 different people at the same time.
Exactly. The legacy system is built on fractional reserves and hidden risk. But by holding this exogenous asset, Strive flips that model completely. They can exhibit their wealth mathematically, directly on the public ledger, 24 hours a day, 7 days a week, 365 days a year.
Anyone, anywhere in the world, whether it's an auditor, a massive institutional lender, or just a retail investor sitting at home, can look at the blockchain and mathematically verify Strive's exact capital reserves down to the 8th decimal point in real time for free.
You don't have to trust anyone.
Exactly. They can see that the $1.2 billion is sitting there, totally unencumbered. It hasn't been lent out 10 times. It is definitively there.
This total transparency creates what the research calls pristine collateral. Because the lenders have perfect, constant, cryptographically assured visibility into the collateral, their risk profile drops precipitously to near zero. There is no counterparty risk. And in finance, when risk drops, the cost of capital drops.
Oh, I see the engine now. Because the lender knows with absolute mathematical certainty that Strive has the $1.2 billion in pristine collateral, they are willing to lend Strive local fiat currency at incredibly low, highly favorable interest rates.
Precisely. Let's say Strive borrows fiat at a 4% interest rate against their pristine digital collateral. They then take that cheap fiat, deploy it in higher yield terrestrial financial instruments, or simply distribute it to their preferred equity holders as a return of capital. They are arbitraging the trustless security of the alien protocol against the trust-based friction of the traditional fiat system.
This is a massive aha moment for me. We talked earlier about how the Lightning Network was built as a layer 2 solution to solve the terrestrial problem of fast payments, right?
Yes, we did.
What Strive is doing right now, using preferred corporate equity, is effectively building a layer 2 for global credit.
That is a brilliant way to conceptualize the architecture.
They are taking the base layer, which we established is highly volatile, mathematically absolute, and completely alien to traditional accounting, and they are absorbing all of that chaotic volatility onto their own corporate balance sheet. They act as a massive shock absorber. They are stripping the volatility away, and what they pass on to the retail investor is a highly stable, deeply terrestrial, comfortable ride of daily cash flow.
They have built a translational layer. They are translating the exogenous, unyielding physics of the protocol into the terrestrial needs of the retired teacher who just wants a reliable daily income stream to pay for groceries. They have mapped the always-on 247 nature of the digital network directly to the human need for daily economic stability.
It is stunning. And if we look at the macroeconomic implications of this transition, I mean, if major corporations can now generate local fiat daily just by holding and verifying pristine digital collateral, the entire boom and bust cycle that has defined the last 15 years of this asset completely changes.
If we connect this to the bigger picture, the research outlines a concept that is truly paradigm shifting for global finance. It calls it the forever bid.
The forever bid. That sounds ominous, but incredibly powerful. Walk me through the mechanics of that.
Think about the incentives at play here. If Strive and pioneering companies like MicroStrategy before them can lock up this alien asset on their balance sheets to issue high-yield preferred equity, they are creating a permanent systemic engine for digital credit.
Okay.
They are proving to the world that you absolutely do not need to sell the asset to realize its massive economic value. You hold the asset, you verify it publicly, you borrow cheap fiat against it, and you distribute the yield.
Which means if you never have to sell the asset to get the value, the selling pressure on the open market completely evaporates.
Exactly. In the legacy era, if a miner or a corporation wanted to realize the gains of their digital gold, they eventually had to sell it for fiat, which created massive downward pressure on the price. That is what caused the wild volatility.
Right.
But if the smartest corporations in the world realize that permanently holding the asset is the master key to engineering low-cost capital and issuing highly desirable equity, they will never ever sell it. In fact, they will continually bid for more of it to aggressively grow their balance sheets and issue more equity.
Hence the forever bid. It becomes a black hole for capital. The asset is no longer just a digital coin to spend on a pizza. It is no longer just a shiny digital rock to passively hoard in a sovereign vault hoping the price goes up. Through financial engineering, it has become active, highly productive digital capital.
It perfectly synchronizes the massive scale and efficiency of global credit markets with the absolute speed and mathematical infallibility of the Bitcoin network. It creates a closed-loop system of continuous value generation.
It's breathtaking when you step back and look at the entirety of the journey we just mapped out. We started 15 years ago with this impossible mathematical paradox. We solved the Byzantine generals' problem of trustless coordination. We brought a truly alien, permanently scarce technology into a digital world that only understood the infinite abundance of copying and pasting.
Yes, we did.
Then, in our first clumsy terrestrial attempt to understand it, we tried to buy fast food with it. When that failed due to economic law, we fought bitter philosophical civil wars over how wide a vault door should be to accommodate global payments. Then, as it grew, we saw global nation-states panic and try to hoard it to protect their geopolitical power.
And now we're here.
And finally, today, with the Strive announcement, we see it maturing into this elegant, frictionless engine that provides a highly stable daily yield to everyday people. Humanity finally found a way to map our deeply terrestrial human need for stable income to an alien technology of absolute, unyielding scarcity.
It is the ultimate maturation of the asset. It rigorously honors the mathematical constraints of the underlying protocol while perfectly serving the practical economic needs of the public.
It really is a profound evolution. It feels like we are watching the birth of a new financial operating system in real time. But as we wrap up this deep dive journey today, there is one final lingering thought that I want to put out there for everyone listening. A massive question that the research subtly hints at, but leaves unanswered for us to chew on.
What is that final thought?
If this digital capital truly becomes the pristine, perfectly verifiable collateral for the entire global credit market, if it essentially becomes the unshakable bedrock of all global value, what happens to traditional fiat-based corporate valuation?
Yeah, that's a big question.
Think about it. If every traditional legacy company on Earth is currently valued in dollars or euros yardsticks that are constantly being inflated, printed, and politically manipulated, will there come a day in the near future when every single company on Earth eventually has to price its stock and measure its actual objective worth against this single alien mathematical constant?
This raises an incredibly important question for the future of markets. If the yardstick you use to measure wealth is constantly stretching and shrinking based on central bank policy, you don't really know how tall you are. You don't know your true value.
Right.
This exogenous protocol offers the world its very first, universally fixed, unalterable economic yardstick. It is a fascinating and potentially terrifying thought experiment for traditional equities.
It changes the entire perspective on what wealth actually is and how it should be measured. Listen, if this deep dive sparked a realization for you, if you had an aha moment today while we unpacked the mechanics of the daily dividend or the forever bid, please make sure you subscribe wherever you are listening right now, whether that is Spotify, YouTube Music, Apple Podcasts, YouTube, or if you are using next-generation value-for-value platforms like Fountain.fm. Hit that subscribe button so you never miss a journey like this.
And as always, we want to hear directly from you.
We absolutely do. We actively invite you to share your own research, your articles, and your notes with us. Why do we ask for research? Because the best ideas don't come from us alone. They emerge when your curiosity meets our process. In one line, your signals are synthesis, AI, acceleration, human obsession, distilled insight. That is the mission, or the flow, of collaborative intelligence. Help us in creating a symbiosis of artificial and natural intelligence, particularly if you have expertise in traditional fixed income credit markets or layer 2 protocol engineering. Send us what you are reading. Send us what you are seeing on the horizon.
The conversation regarding this protocol and its impact on digital credit is just beginning.
And finally, keep searching, keep the quest on. See you on the next deep dive. I'm Satoshi.
And I am Satosha.